I'm Andrew with Jesani Wealth Management, and the modern portfolio theory, which is probably the most commonly talked about in a very basic theory, stating that the investment theory that allows investors to assemble an asset portfolio that maximizes expected return versus a given level of risk, which Ray Dalio, also who's probably the most noted fund manager of our time, stated that knowing how to diversify well is more important than almost anything else in the investment world. So what we're talking about here is really strategy correlation, which is part of the second dimension of our multidimensional asset allocation strategy. And strategy correlation in its purest form is the way that two securities or assets move in relation to each other. So the first step in doing a strategy correlation test is a correlation analysis, which is a statistical method that's used to discover if there is a relationship between two variables or two data sets, or in this scenario, two asset classes, and how strong that relationship is. What you're trying to accomplish is to decrease diversification risk, which is simply the risk that all assets in your portfolio move in similar directions and similar times based off of similar economic or market factors. So each asset class or investment has what's called a correlation coefficient, which can range from -1 to +1. -1 meaning that the assets, or the two assets that you're looking at, move exactly opposite of each other. +1 means that the two assets move exactly alike. And of course, 0 means that 50% of the time the asset is moving in the opposite direction. The other 50% of the time that asset is moving in the same direction. Now, Ray Dalio, in his Holy Grail theory of investing, which has served him quite well over the past 40 years, focuses in on this strategy correlation and having 5 or more non-correlated assets in a portfolio, which shows that you can dramatically decrease your risk while not also decreasing your return at the same time. So let me show you what some of the coefficients look like. Here you see the S&P 500 on the far right, and also at the bottom. Of course, they're lined up at exactly both a +1. But then when you look at S&P 500 versus managed futures, you're at a 0.15. And then if we go into negative numbers here, international equity versus currencies are negative 0.52. So that means 75% of the time, these two assets are moving opposite of each other, which by having those in your portfolio is going to dramatically reduce your risk. A good example to kind of explain how lowering volatility can increase the performance of a portfolio is using portfolio A. Let's say we have a $100,000 investment. At the end of 1 year, we have a 20% return. So that portfolio is worth $120,000. Then at the end of year 2, we have a 20% loss. So now that portfolio goes down to $96,000. So let's compare that to portfolio B, where at the end of year 1, we have a 10% gain. So we're at $110,000. End of year 2, a 10% loss. We're at $99,000. Well, obviously, portfolio B outperformed portfolio E simply because of less volatility. Similar to the fact that if you have an investment and it drops 50%, you now need 100% gain to get back to break even. So creating a portfolio that has many different asset classes with high and low strategy correlation, things like private credit or private equity or structured notes or real estate syndication or REITs or currencies or long short strategies, can get you to it's called the efficient frontier, which was part of the modern portfolio theory created by the economist Harry Markowitz, that states that you're achieving the best possible return at that stated risk level of the particular investor, which depends on a case-to-case basis. So if you have any questions about strategy correlation or the analysis that we've done on our multi-asset allocation strategy and the asset classes. Within that, my name's Andrew Constantinidis, and I can be reached at 954-800-8552. Thanks, everyone.